Hello, my name is Tiffany C. Wright, and today we have another helpful tip from the Resourceful CEO. Today I'm talking to you about sales incentives. Now, these are sales incentives for your sales team, your commissions, bonuses, and so on. That's what we're focusing on. And I'm not going into how to structure your commissions or how to structure your business, your bonuses, and why and how and empowerment. The focus is on how the structure of your sales team's compensation impacts your company's bottom line. And I say this with all due respect. There are so many companies out there who pay their salespeople based on top line revenue. So the overall sales value of the contract, whatever that is. So someone sold a $150,000 contract. They pay the salesperson based on $150,000 on the $150,000 sale, and they pay the salesperson immediately. So there's no consideration for the impact on the company, and there's no consideration paid to whether or not that billing is collected. The main way to structure, or the main thing to keep in mind when you're structuring, is to make sure that you tie it to a number below the top line. So typically, I recommend that you tie it to gross margin, but you can tie it to profit, to the net profit margin, or to some other number in between net profit and gross profit. You know, when you're looking at a income statement, you have top line revenue, then you have, returns and so on. You have net revenue, then you have your cost of goods sold or cost of services sold, and your gross margin. Gross margin is what I'm talking about. After the cost of selling all of your services or your goods, that's the gross margin, and that number needs to include your sales commission paid out to your salespeople. And anyway, so whatever margin you want to have, so if you want a let's say a cost of goods sold of 70% and a 30% gross margin, then when your sales team brings in deals and they're paying at 30% gross margin, then you pay them their full commission. If it's higher, then you give them an additional bonus. If it's lower, then you take some away. The other thing is collectability. If your salespeople are out there selling, but you can't collect on it, what good does it do for your bottom line? It looks good on paper. Oh, we grew from 10 million to 20 million in revenue, but we've collected on 30% of those receivables. I mean, that's awful, but I've seen it happen. You have to tie the collectability of your revenue to your incentives. If you immediately pay out to your sales team as soon as the contract comes in before the customer is paid, then what's the sales team's incentive to collect? They have their relationship, but now they move on. This also encourages them to build a little bit stronger relationship, because they need to make sure that their new customer pays and pays consistently. So it works out well for you. It increases your cash flow because your sales team is motivated to collect so that they can get paid their commissions and bonuses that are due them, and you have more cash. So again, it's like beating a dead horse, I know, but the point is that you need to focus on gross margin, tying your sales structure, your sales commissions, incentives, not your sales structure, but your sales, the way you incent your sales team, tying that to gross margin or some other number below that, and to the collectability of your invoices. I'll share some real life horror stories in another episode. I'll just leave it at that. And that's another helpful tip from the Resourceful CEO.